Oh, okay.
So that is also.
Do we have a need for a closed meeting today?
Not yet.
Not yet. Okay.
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 Well, let's, page 5 and 6 in that packet are the, the committee meeting minutes from our last, committee meeting in terms of the plan. I know we had another one regarding the record-keeping analysis, and we'll, of course, update that. You can see on page 6 as far as, items broken down for, what needs to, you know, in terms of action items that are there, and we'll kind of go through and update on those. If you'll go down to page 7 on the business calendar, again, this is the areas in which Soltis is engaged to assist on your plans and consult, and so we've just got this broken down by quarter in terms of what things we're focusing on. I think it will look here at kind of third and fourth quarter, but obviously the vendor RFP review was completed, and Prudential was selected to be retained as the current record keeper for all 3 plans. I know the discussion has also been to look for and move forward with the 401A merger to consolidate that plan, and so we're working with, and Prudential's already working to move through that. And then today we'll go through, we've got on here under third quarter updated fee policy statement. We, of course, in the last meeting we spent some time on there. We've drafted the language kind of commensurate with how the committee indicated they want to handle revenue share going forward, and we'll kind of review that with you and the options, and then if we need to make updates to it, we will. As we get ready for fourth quarter, and we're here in the fourth quarter, obviously there's 404A fee disclosures and 408B2. I know that obviously as a non-ERISA plan, you're not required to send those disclosures out, but our understanding has been that the practice has been to typically get those out and send them. And so, Kelly, in terms of timing, has Prudential been instructed or slated in terms of having the disclosures go out?
Not yet.
Okay. So I think that's an item in terms of the committee. If they want to have those disclosures go out, we can work with Prudential to ensure they do. Again, you're not required to, but we'll help review and do that if you'd like to. We also just conducted our third fiduciary committee fiduciary training. I know Brian was able to attend, and we were glad to have him there. That training will, we record it, and I think all of our providers allowed us to record them. Not all of them allow us to record their presentations, but we've got that documented in terms of obviously Brian being there, and then for any of the other committee members that weren't able to attend via phone or in person, there's a recording that you can go in and go through that as well.
I was online, does that count?
It does. It does.
Okay.
We've got documentation of it.
Okay.
So, okay.
Can you send us the link to that
Yes.
training?
We had a little bit of technical difficulty, so Lindsay's patching it together. But yes, as soon as we
Okay.
have the recording, it'll go out to all committee members.
Thank you.
Yep. Okay. Any questions on? Well, let me over on the right-hand side. Obviously, as we get to near the end of the year, obviously we feel accountability to the county in terms of what we're doing and trying to assist with on the plan and so on. There, we will typically report results and performance of things that need to happen on the plan. We've got laid over on the fiduciary risk and mitigation. As mentioned earlier in this meeting, we create and maintain a digital as well as a hard copy fiduciary file from when we were engaged. So January 1 of this year, we've been keeping a complete fiduciary file for the plans, and you all have access to that. We were once again certified by CEFIX this year, the Center for Fiduciary Excellence, which is a third party that comes in and audits our firm in our practices to ensure that we're following best practices for fiduciaries. So we were recertified again in 2018 and anticipate that will happen again this spring. Around fiduciary education, as I mentioned, we've had 3 trainings this year that we've conducted on behalf of our fiduciary plan clients to help them understand and follow their responsibilities and guidelines. We've gone through, and I know everybody on here has gone through the exhaustive process of a vendor RFP, and gone through that. We have updated the investment policy statement. You had one in place as we came on the plan. It's been refined a little bit and done, and then we introduced a fee policy statement, which we went through in the last committee meeting, and have implemented that on the plan. Plan design, benchmark, and analysis, auto enrollment, those are a couple of those items that we looked at as we were going through the plans and looking at that. We can kind of go through that further as well. And then, of course, the trainings, and then I think right down here under investment reviews and updates, obviously we've noted the meetings that have been held with the committee. And then we also just list there on the bottom, you know, one of the things that we try and do is make sure that you've got a competitive investment menu. Obviously, a big part of our role is to help ensure that you've got good performing funds in your plan with competitive expenses. And then we track that on a regular basis. And so we look at the average excess return. Right now, of the managers in your fund, you've got about an average excess return of about 0.94. So in other words of looking at that, it's looking saying, hey, the average fund in your plan right now is outperforming a benchmark. It's benchmarked by about 1%. So that's part of the value that we want to drive. And then you'll see that they're beating their benchmark almost nearly 80% of the time. And we run those numbers off a rolling 5 years. So we're kind of doing it every month. We're running those numbers to just kind of see how consistent we've got these managers as we're watching them and doing that. Any questions on the business calendar? There's a lot there, and this is an important document. Of course, it's your document, so we can prioritize and do that. As we get ready for the first quarter, we'll, of course, come with a draft of 2019 and be able to go through that with the committee for what we are looking at into 2019, and we can make changes as needed. Okay. Go back here, and then let me go to investment policy statement. So if you go to tab 6 in the packet, and I won't take a lot of time here, but each time we hold a meeting, we come with an updated investment policy statement for the plan. And so probably one of the most important parts of this is on page 88, where it shows what the funds are in the plan. You know, there were a couple of changes made earlier in the summer. Those are now reflected in here, and so you see that. So each time we come, we update your investment policy statement so that it's basically updated every quarter. And that's just what we feel is a best practice. Of course, that investment policy statement then defines the roles of this committee, the role, Soltis's role on the plans, the criteria for which we monitor and evaluate the funds, including the target dates and asset allocated type of portfolios, and goes through it. And then, of course, the reports that we go through are built directly tying into this criteria. So again, we document the process being followed. Next is our fee policy statement. And let me get to if you go to, forgive me, I'm looking at my digital copy here. We got that. Right. So right after the investment policy statement.
Page 99.
Yes, thank you, Dave. So as mentioned earlier, this is the fee policy statement that we've drafted and has been adopted on the plan. Again, what I'll mention about this is not a contract, so it's not a contractual type of document, but it sets forth a policy on how the fees are assessed and handled within the plan. And so when we look at how to handle those, if you look at page 101, I want to just point your attention to allocation of revenue sharing. And so in the fee policy statement, at the bottom of page 101, you'll see this is talks about how you can allocate. And it says fiduciaries must also decide on the method of allocating revenue sharing among participant accounts. The most common methods are, and it sets forth the following. So these are methods in which the Department of Labor, in terms of being able to go through an audit and show, hey, this is how we allocate revenue share, this is how we handle it. And so we lay out in the fee policy statement for you as a committee, these are the different options you have, essentially, that we feel that we're comfortable with in terms of allocating that revenue. So you can see here some of the revenue sharing is held in expense recapture account. to pay for various expenses of each plan, such as legal, training, accounting, and other administrative costs. We've talked about that, and obviously the plan is utilized an ERISA account, although it's technically, I guess, not an ERISA account, but it's a revenue share expense budget that's an asset of the plan. And then in that, in that revenue share, you can allocate that cost. If you have excess that's there and you want to give it back to participants, there's 3 ways in which you can do it. You can do it pro rata to account balances, you can do it per capita, or you can just do an equalization. And so when there's excess revenue that comes in each year, you can make a determination on how you want to handle that. This gives you kind of 3 different ways in which you can do it along the lines of how we do it. So in the policy statement, we kind of go through and we set forth, hey, these are the different ways in which we can handle it. How do we want to handle it, et cetera, in that. And then we go into, if you go down to page 106 and 107, we actually state in the policy which one of those options we are planning to follow. And so I wanted just to review this with the committee members. First is if you look at allocation of revenue sharing, and you'll see here where if you go down below there, which is allocation of planned administrative expenses, the plan sponsor in its discretion has elected to allocate plan level administrative expenses in the following method: plan level per capita. So each participant is charged an equal share of the general plan expense. So this is in line with the per account fee structure that we've talked about, and I understand the committee's looking to move forward on with the new contract with Prudential. Okay, so that talks about basically per plan level per capita, each participant, each account, regardless of the dollar amount size that's in that account, is paying the same fee to be a participant in the plan. Okay? Investment in individual expenses, the expenses for managing and operating each investment will be charged against that investment. The individual expenses will be charged against the accounts of the participants who incurred these charges. And then we've got in here that the revenue share that goes there will then just be rebated back. Whatever doesn't go into the ERISA account, we'll define in that, again, the language in the municipal policy statement. What we'll do is determine the amount that's in there. We'll make sure that language is reflected here of, hey, there's X amount of revenue share that goes into the ERISA account to pay certain expenses, and then anything above and beyond that would just be rebated back. If you want to do that, or we can again wait and let that excess build and then handle it at the end of the year. So I think that's kind of a action item or a decision by the committee in terms of, I know we've kind of had some discussion around that of, I understand the committee wants to look to say, look, we're going to have the revenue share, we're going to set aside a certain amount to pay for certain expenses for the plan incurs, and then the remainder we could look at and rebate back once a year. Is that correct?
Yep.
Okay, is there a ratifying vote that needs to take place or approval by the commissioners?
Well, just a question there. First, with regard to the fee policy statement, is there anything new in here that's different than the one we adopted at our last meeting? It's the same thing.
Same thing,
Same
yeah.
document, right?
Yep.
So this one, you're not proposing any specific change to this, other than a recommendation with regard to how the fee will be assessed going forward?
Yep. Yeah, and we would, if that's how, if we're gonna, kind of the discussion we had earlier, in terms of allocating the fees and setting aside a little bit of revenue share to pay certain fees, we would update this to reflect language that shows, hey, the revenue share is gonna come in, we're gonna take a portion of it and allocate it to plan administrative costs, and then the excess will build and follow that way.
So I think you want to vote on the draft when that's ready to go, right?
Well, I guess I would make a recommendation I would make a motion that we recommend to the Board of County Commissioners that for 2019, we have a quarterly fee in the amount of $12 per account, so that we can make that plan going forward for 2019, and then that the fee policy statement be amended to reflect that change. And with regard to any revenue sharing that is incurred, those funds would be rebated to the account from which it came, from which it was generated.
Okay.
Is that all you need? Is that enough?
Yeah, so
Anything else you want there?
Yep, so we'll have the language So we already have the plan per level per capita. That
Right.
language is in there.
Right,
The,
okay.
the allocation of some of the revenue share that goes for some of the planned administrative costs is the update we'll need to make. And then we'll just add language that in the case that there's excess, it will just be rebated back pro rata, which means it will go back to those participants in which it came from.
Well, my understanding was that the revenue, any revenue share that is generated would be rebated to the specific account from which it was generated.
So if you want to carve off and have some expenses paid from the ERISA, you've got to have revenue share that would come in.
Well,
So anything above that, you could do that.
the revenue that would come into that expense account would be, my understanding would be the difference between the prudential fee, quarterly fee, and, which would be $6 of the $12. And then the other $6 would go into the account to
Into the-
pay all of those other expenses.
Okay,
So there would be no need
no
to
need to
have
even
any
capture the
revenue
revenue
sharing
share.
going into that account.
And that's okay by Prudential, you guys can pull that in, allocate, right, if they do.
So if I have an investment in my account that generates revenue, that revenue amount, whatever it is, would just simply come back to me.
That's our fee levelization, right, so say you have a bond fund that you paid 12 basis points for, $6,000,
Right,
you will get that 12 basis points back.
correct.
And then we will look at all account balances, right? And then we'll take our fees off of that, but whatever you generated revenue for, that participant gets that back. So
Correct.
it looks like zero revenue share
Okay.
across.
So any revenue share goes right back to the account holder
That
who
is
generated that revenue.
pulled from the mutual funds, correct?
Correct, right.
And then of the $12 quarterly fee, there's going to be, Prudential only takes 6 of that, so the additional 6.
Well, it's $6 a quarter, right? Because it's
Correct.
$24, yeah.
Yeah, but we're talking about a per quarter fee that's charged of 12.
So 6 would go.
Oh, I see what you're saying,
6 goes
with
to
both.
Prudential, and then Prudential would take
Yep,
the other
yep.
6 and
I
basically
gotcha,
put it into the
I'm on
ERISA
board
account.
now. Mhm.
So I just want to make sure, in terms of
It's
logistically-
total, right, it's
Yeah.
not gonna be broken out.
And
It's gonna just
Prudential is
say-
okay to do that, they can take 12,
Yeah.
6 goes to you, you'll take
Yep.
the other 6, put it in the ERISA account. Okay, okay.
So that way, any revenue sharing goes right back.
Just goes right
to the
back.
specific individual who holds that account.
So it'll be broken out on the administrative services agreement that will be sent to Ralph of how the fee will be paid. It'll be the $12, it'll be the $24 record keeping annual charge, and then it'll be whatever the annual charge is. I think we
Right.
came up to 24.
Right.
So, and that will be broken out, and then that's how it'll be set up in the system.
Right. And there would only be revenue share generated on those specific investments where it's determined that that is the best option.
Right. Right.
And it's the best option also because that revenue comes right back to that account.
Yeah, mutual funds are starting to fix that. They're starting
They
to
are.
fix, so what happens is you look and see, oh, their zero revenue share actually is a detriment to the participant. So
Right.
we're gonna go ahead and take the revenue share that's, we call net, better for the participant. Hopefully in a year, most of those we can move to zero rev and it'll be
Yeah.
kind
Yeah.
of a non-point.
Under the fee levelization, though, will we have the ability to use a revenue share that provides a net lower cost to the participant? Or are we required to use,
Are you talking about like a separate account or a CIT or?
well, either a CIT or a fund? Just if there's a share class with a 0 revenue share, but the revenue share class is actually, because it's getting credited back to the participants?
Yeah,
Is
can you
We
use
want to
it?
have the ability to still use the
Yeah,
revenue.
you can, sure.
Okay.
If it's higher,
We can still use.
where we have more discussion to talk about is one of, that are below zero rev,
Yeah.
that are
Yeah.
customized.
Yeah.
But anything above that 40 Act zero rev, I mean, we still have funds that, we still have clients, believe it or not, that are zero rev, but they have some built in onto the S&P,
Yeah,
you know, so yes, we can do that.
okay.
So I don't think that will require any amendment to the fee policy at all because that's what it says now,
Yep,
right?
correct, is it's getting credited back.
Yeah.
You're amending, of course, you have to do it in form of motion.
Yeah.
Except we don't need to because it's already in there, right?
It's in here, well.
Yeah, we need to make
the
one
part-
update
oh,
to the policy
okay.
statement that talks about, a portion of the fee that, the per account fee, a portion that's gonna go into the risk account to cover costs. So we'll need to make that update in here to reflect
Okay.
that. But that'll be the only change,
Well-
I think everything else is coming.
I would amend my motion to include that part.
Okay, so we have a motion to amend the fee, policy statement as discussed by Dave. And does anyone have any questions about that first before we begin?
Just one quick question, will that revenue share show up in the statement? Or is it just kinda
No, you'll
netted
see a
out?
credit on that fund, on
Okay.
line item, on a credit on that fund.
Does it
Yeah, so
show-
yes, I mean, it'll show up on the statement, but not in your total fees part, wherever that fund
The
is.
participant will see the credit.
They will see
Participant
it?
will see the
So each
credit.
quarter, they're gonna see credit of X amount of dollars.
Yes.
Okay.
Comes back.
Yeah. Just wondered if that would show up or not.
Okay, we have a
We can
motion.
if
Do we
you-
have a second? All in favor, say aye.
Aye.
Aye. This amendment to the fee policy statement, passes 4-0.
So Tyler, I do want to talk about timing about that a little
Yep.
bit. So we are repricing the plan at the 24 on January, for January 1 going forward.
Yep.
We won't be able to, because we don't have all the notices done. So what will happen is we will move to zero revenue share fee levelization in the first quarter to happen for 1, because we can't get
Yeah.
it done now and we only have 40 days left in the year. So the pricing will change 1/1, and then all the
Yeah.
work we need to do around bringing everything down to zero, sending out fund change notices, some communication around how their statement's gonna look, how the fee levelization works, that will actually turn on 4/1. So I want everybody to be aware that the first time they'll see it is 6/1, because we charge in arrears. I know upstairs we talked a little bit about 4/1, but it's actually gonna happen 6/1, because we need the first quarter to put it in place. Does that make sense? Just from timing perspective.
Yeah.
But the fee won't change, it's, we're
Right.
gonna, we're gonna bring the lower fees in 1/1.
Great. Okay.
Just qualification though, on this, let's see, do you need, we had the change of the fee policy. With regard to the investment policy statement, is there anything new in here that's different from the one we approved last time? Or is it an investment account?
I'm trying to think if we had the funds, we had a
We're
couple of
changing a
funds, well,
fund?
they were done, so,
It just has the updated funds.
yeah.
Is the updated fund?
Otherwise, everything else is the same.
So
Criteria.
we need to recommend that change
Recommend
then.
that change?
Yeah. Okay. So I would make a motion that we recommend the amendment to the investment policy statement with regard to the listing of the funds.
Okay, we have a motion to approve the recommendation of the funds in the investment. Okay, yeah, do we have a second?
Yeah.
Okay, we have a motion, motion
Can
and
you
a
just
second.
explain
Oh,
that real
yeah.
quick? I didn't-
What is it? Just with regard to the investment policy statement, they're updating the
This
list of funds.
right here on page,
page.
page 88. They're just
Okay,
updated.
it's just updated,
Yeah.
I get it.
It's this.
I got it.
Okay, we have a motion and a second. All in favor, say aye.
Aye.
Aye. Okay, motion passes 4-0.
Who's seconding that?
I did.
Okay, if we move down to page 15, if you go to the fiduciary spotlight tab, go to page 15, this is kind of one of the last governance documents that we feel is the best practice to have on a plan. It's what's called the Charter of the Investment Committee. And I'm sure this committee is more familiar with, or more than familiar with, is the committee charter. The reason we feel like this is an important governance document is it specifically states who has decision-making authority for the organization and what those people's roles and responsibilities, and if they bear fiduciary liability for the plan. And so you'll see, we've just included a draft here. And if you look at that draft, you're gonna see language that's typically for the private sector, so you'll kind of see that, but of course that can be substituted. Again, this is your document, so this is just our initial draft that we've provided to you. but again, the purpose of this document is it's kind of twofold. One is it's so every member of this committee has it clearly defined for them what their role is and what their ability is and what their fiduciary responsibility and liability is as a member of this committee. And so it clearly defines that for the organization, for the participants, and the committee members. Two is for the organization. It specifically states who has and how decisions are made, you know, what it's required. You'll see in here language like you've got to have a quorum present, et cetera, or a quorum present to be able to make a decision. Obviously, we know that this committee takes recommendations to the commissioners and does that. And so we would recommend having a charter in place for Utah County's plans, so that there's no kind of gray area as to what this committee is able to decide and do, what needs to go to the commissioners, et cetera. So it's very clear and stated in those terms. You may already have, I don't know if you have sometimes organizations will have this already in an organizational charter where that's spelled, so we can take some of that language, but this again is just a draft, and we wanted to kind of bring it to your attention, maybe have you look at it, and our recommendation would be to put something like this in place, and we'd probably work with Dave on getting the language drafted specifically for the plan on how that would work and do that.
So this would be in addition to what we already have in the rules and regs as far as the organization of the committee, correct? And do you think that's needed, Dave?
Well, what I'll do is I'll get to you a copy of the ordinance that created this board,
Okay,
and then maybe you can look that over and see.
that would be
if
great.
We could
That's a good
go
idea.
from there.
That's where I thought you guys might have something in place.
Yeah,
A lot
we
of
do.
times organizations don't. They've never.
Probably not as
So-
much detail as this, though,
Yeah.
And this is obviously very specific to
but it might
The
be good to
retirement
add this in,
plans.
so.
go. Okay, but yeah, we're happy to do that. So Dave, if you want to send that to us, we'll
We'll do
review
that.
it. And then we can probably circle with you and in terms of whether or not what you have is sufficient, or if you want to add a little bit to it, or we want to refine this a little bit.
So question, does a recommending committee typically act as fiduciaries? Is that normal, or is that kind of unusual, or?
We see it more so than not, but we do see committees where if they don't have decision-making power or voting power, that they are acknowledged, that, you know, the committee will say, hey, you know, if you don't have decision power, we may not have you hold that, you don't bear that fiduciary liability. So we have quite a few committees where you'll have, you know, 6 members and 2 of them are non-voting, and therefore they don't carry. They acknowledge that I don't have fiduciary liability because I don't have decision-making power on the plan. So it's really kind of up to the organization to make that. But again, it defines it for them so that, hey, you're a member of this committee, yes, you are a fiduciary, or no, you're not, in that sense.
Is there an ability for us to define that we are not a fiduciary?
Yes. I mean, the,
You second on that?
so yes, you could. I mean, in terms of this committee,
I know where you're going.
you could look and say, if the commissioners, and you wanna look and say, hey, this committee is simply a reporting committee, to where you're bringing recommendations but the ultimate decisions, but that's one of the reasons we brought this up, is I think it would maybe help you guys to look at it to say, hey, does everybody on the committee, or the only certain members, or do none of the members want to actually acknowledge and take on fiduciary liability, or does that reside up at the decision-making level? You know,
The entire committee ex officio.
yeah. But this document gives you the ability to define that or do that if that's what you'd like to do. So, again, the reason we look at this as a best practice is it does define, hey, this is what you're allowed to do, this is what type of responsibility and liability you actually take on as a member of the committee. And the organization's acknowledging it, saying, yes, we are acknowledging that you're in that role and capacity. Good. Okay. Let me go to, I'm gonna go to the regulatory update, and then Lindsay, do you wanna take them maybe through the CIT or the CIF calculations? Okay. We wanted to just make sure you're aware in terms of updates. We kind of mentioned the fiduciary training that was just held. We've got an action item there. As soon as our recording's done, we'll send that. The entire committee will get a copy of that. And then I'll have Lindsay take just a minute here on the collective investment fund initiative that we've been working on. I know we've talked a little bit with the committee. We've got some numbers for you to look at today. And with the, and then I want to do just a quick regulatory update. The IRS, in just the last couple of weeks, has released the new limits. If you look at page 14, so it's actually the page right before that committee charter that we were just at, you'll notice that the IRS actually just raised the limits on a number of things. We want to make sure you're aware of it. So, for example, one of the big ones is elective deferrals has gone up by $500 in 2019. Any participant will be allowed to do $19,000 of their own compensation into the 401k. That's up $500. You'll see the defined contribution limit between their contributions and company match has gone up by $1,000. The annual compensation limit has gone up by $5,000. Catch-up contributions remains the same at $6,000. Highly compensated employees has gone up by $5,000. And then you can see under 403B those changes as well, and salary base and some of those. So those are the new limits that, again, most of those have been adjusted upwards and will be effective January 1st, 2019. We want to make sure the committee is aware of those. Prudential will have those loaded in, and I'm sure be moving forward with that in 2019 so that your participants that are trying to max out or those type of things, they'll.
Yeah, we stop them.
Yep. Okay. Any questions on those?
Nope.
Okay, Lindsay, you want to take them into the CIT and?
Yep, so we will be right in front of the supplemental information on page 52 and 53. So Soltis as a whole, we have taken all of our T-row target date funds, and we are getting a lower share class in the form of a collective investment trust. So on these two separate pages, on page 52, this is if you maintain the same revenue share, how much savings would be for your participants that are in the target date funds as of right now. So you can see if you maintain the same revenue share, it would conclude around $11,000 of savings for participants. They won't see a difference in their account from the CIT. They'll just get this in extra return per year of that couple of basis points for each one of those. The page below on page 53, so if we went to eliminating all revenue share, this is the total savings that you'll see overall in the participants' accounts, which is just north of $31,000.
So again, I'll just kind of restate, we are doing this because we have about $3+ billion in retirement plan assets, and typically you could only do this type of collective within one plan, but we have tried to be progressive and innovative here and approach asset managers, and we've been successful in being able to negotiate this not just in a per plan but across our entire book of business. So there's a benefit of, Soltis is able to negotiate, and we're targeting January 1 to have these available. It will likely be first quarter in terms of hopefully we're hoping to have them open and ready for funding come January 1. There's a few other logistics that go in there, but kind of the first quarter of next year is when we anticipate we'll be able to kind of begin moving or mapping assets. And I think there's two things important for you to all know. One is these will be specific to Soltis. So as our client, you get the benefit of that kind of bulk pricing across our book, which is what we're doing it for. Two is there is no additional compensation that's built in for this. In other words, Soltis isn't making any additional money or revenue to do this. We are just simply looking to say, look, this is value that we can drive, and we can use our size to help our clients in that aspect. So there isn't any additional compensation that goes to us when we implement these. So we don't want you to feel obligated to do this. T-row price target dates are already in your plan. So this would be a very simple, we just replace them with our collective, which is the exact same fund as Lindsay just mentioned, but just with a much lower expense ratio.
So,
Prudential can record keep them.
yeah, that was my question, is about the record keeping.
Those are part of the
I'm-
logistics. We're in discussions
He's
with
working
Prudential.
with some other people, and as of now, the answer's no. But I know you're working with, you have to get them funded and on the platform first. Now, I will caveat, and this is something that isn't necessarily directed at Soltis. It's directed as us looking at what our platform looks like on a go-forward basis for all advisors and all mutual fund family companies, that there could be changes to how we bring those in, meaning there could be some setup costs and things like that. that has not occurred, but I just want you to be aware that those discussions are happening at a grade level higher than me. For some of these funds that are happening, because we have in the past had some situations where we put these on as an accommodation and now they sit empty.
Yeah.
So, and you're aware of all that, but I do think it's fair for the commission to know that, you know, we are working with Soltis. But the final decision is not something I can make. It's something that he'll be working with the investment fund people with.
And I think just for the committee, we're in discussion with Prudential. They have said that they can and will put these on the platform. There is a setup fee, and we're negotiating that right now. And we want that to be as minimal as possible. Some platforms, a lot of platforms don't, or some platforms don't charge anything, some do. So those are some of those logistic discussions that we're having and doing, and of course we want to minimize the cost impact by doing that. And Kelly brings up a great point. At the same time, we understand that platforms don't just want to put collectives on their platform, because it's a cost for them to take them and maintain them, and of course not have flows come into them. So that will be coming in fourth quarter, but at least you can see the dollars again. I think as we look at this, with the revenue share 11,000, and when you take it out, we go to zero revenue share. It's about a $31,000 a year. That's just for your participants in those funds. That's just for that part of your plan. So you can see the fee we've been able to renegotiate is pretty competitive for sure.
Have you set these up for other investments other than T. Rowe Price?
Yes, we are. To negotiate a collective, you've got to have typically 200 to 500 million in a position. And so as you can, even at $3 and $4 billion at our firm, we don't have, $200 to $300 million positions in every one. And then you have some funds that are closed and smaller, and so they're not, there's no motivation for them to say, yeah, we'll let you negotiate a lower fee. If they're closed already, they're kind of telling us, hey, we know you have a big position, but we're a good fund and we've had good returns, and you're either going to stay with us or you're not. So not every fund is available, just in terms of whether or not they'll let us do one. But every place that we've had basically over 200 million, we're working to negotiate. And there's a few more that will likely come, but the T. Rowe Price are the kind of our biggest, and so we're pushing those through initially on the first run.
And then the only other comment I would have to join in with Soltis is, if truly you're looking to look at customizable fees and you're looking at lowering cost of mutual funds, we also have separate accounts available that are similar to CITs. They're packaged under insurance instead of a bank. And we'd be happy to work with Soltis and have our investment, Rob Craddock, work with him to kind of show you some of the other ones that we have that are well performing. And we hire the managers, we have some T. Rowe, we have some other managers as well. And as we're doing this project, it might not hurt for us to just show those to you as well, if you're looking at customizing fees.
Okay, any questions there?
Nope.
All right, let's just go into, I know from a investment review standpoint, I think we've been through this a couple of times, but if there's a need to refresh, let's do. But I want to take you specifically on, we have a number of changes that are queued and ready to go, and I'll go through those in just a minute. But there's one that has changed, and again, we had initially, months back when we kind of began this discussion, it was looking to replace or add an emerging market option in your plan. So you didn't have one that was in there, and so we felt like the emerging market part of the investment world is an important part. It's certainly one that has some opportunity, and so we've gone through. We had recommended a T. Rowe Price Emerging Market Fund. That's a fund that has since closed. It's hard closed. We're able to use it for existing clients, but even T. Rowe Price won't allow us to use it for new plans. And so we have an updated recommendation there. If you go to page 45, under the investment plan or the plan investment review tab, you'll see we've got basically kind of a breakdown fact sheet of the Fidelity emerging market portfolio. And then so our, again, this is an addition. So this isn't a replacement. We're not looking to map or replace one of the funds in your plan. This is just an area where you don't really have a dedicated emerging market option that's available to participants, and we think that's an important part. So this would be an addition to your current plan lineup. And this is a really good management team. Fidelity does a good job here. The manager's been the manager for about 6 years, but been on the portfolio for closer to a decade. If you look right there in the middle of the page, you'll see in terms of 1 year, 3 year, 5 years, see those numbers below, 38, 25, and 47. Those give you the quartile rankings. The lower, the better. They tell you which quartile they fall into. So you can see that this manager has largely been in the top quartile or very close to it for the tenure of the firm, or the tenure of the fund, excuse me. And it's a fund that doesn't have gigantic assets in it, so in terms of availability, it's open and one that we can continue to use. And so our only change to those recommended changes and additions that we have gone through would be to include or add the Fidelity Emerging Market Fund to the plan lineup. You can see right below those numbers in terms of expenses, it's well below the category average. That's one of the criteria in our investment policy statement, is to use funds or look at funds that have below than average expense ratios. And then again, in terms of excess return, over on the right hand under that 60-month rolling return chart, what you'll see is this fund has been in the top quartile about 36% of the time, and in the second quartile about 50% of the time, which gives you about 86% of the time it's beating its benchmark, and then it's had an average excess return over that 5-year period of about 1.31%. So again, been a really good manager. They've done a good job of adding additional value. They've got good competitive fees and have a tenured team, and so that's the fund that we're recommending in terms of adding an emerging market option in the plan.
So
Question-
Kelly, any any issues from the record keeping standpoint on this one?
Nope, that one's there.
Was that already listed in our list of funds in our investment policy statement?
It's not, because it hasn't
It's
been, once it goes into the plan, it will then be updated in the
Oh, I see.
IPS.
So you need a recommendation then to add that fund as an option?
Yeah, that's our recommendation, is that we add that one, we add that fund in instead of T-Rowe Emerging Markets, which is closed and we can't access.
Okay, do I have a motion to recommend the Fidelity Emerging Markets Fund for our fund lineup?
Yeah, I'll make that motion.
Do I have a second?
Second.
We have a motion and a second. All those in favor say aye.
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 Aye. Okay, that passes 4-0.
Okay, we'll work with Kelly, and let me go through the other just changes as well that are queued and ready now that the record-keeping decision's been made. On page 5, just right back to the beginning under our last committee meeting minutes from August. These are the other changes that are queued and ready. And just as a refresher, we looked at the entire lineup. We made recommendations around, even if you had a couple of funds that had done a pretty good job, they weren't on watch, but we even made some recommendations. We looked to kind of consolidate. You had a few funds that were duplicative in their exposure, and so we tried to consolidate as well as look to add some options in the plans to where you, particularly in the international side, to where you haven't had as much in terms of choice for participants. And so I'll just go through these. You have the Janus Henderson Flexible Bond Fund. The recommendation there is to replace that with Metropolitan West. To Kim's question earlier, Metropolitan West is one of the collectives that we'll have as well. And so if that one's not ready by January 1, it'll be very close. But even without that collective, they've been a really good fund. They've done a good job, very good tenured team. In the large cap space, this is where you had some duplication. You had Invesco Growth and Income, JP Equity, which are both kind of that large cap value core space. Oakmark, which is run by Bill Nygren, is the manager that we have highest conviction there, and that was our recommendation there. Oakmark is also one in which we are working on a collective, so his fees are already competitive and as well. The ClearBridge Large Cap Growth recommendation is for the T. Rowe Price Blue Chip. That's also one of the ones that we have a collective for. So you'll see that one as well, and that's been a T. Rowe Price Blue Chip has been, ClearBridge has done a pretty good job, but Blue Chip is they've been very, very good. The two index ones in the mid and small, those were already done. And then the last four here, these are the additions, so the ones I just went through, those are replacements, meaning those participants that are in those funds, they'll be mapped to the new fund. These next four are just additions, so they'll just go into the plan, there won't be any dollars that get diverted there or mapped there, these will just be new options that are now available. We're, again, recommending Grandeur Peak Global. This is a global manager that has the ability to go out and invest in a portfolio that buys companies wherever they are. They're just looking for good companies, and we think they have an opportunity set and do a very good job of bringing some good global exposure to your plan. The emerging market that we just talked about gives you the ability to say, I also, for those participants that say, look, I want to participate or invest in some of these emerging economies, they can. And then in keeping with the index availability as well, we look to add an index there. So for those participants that want really low-cost indexes, they'll have an index in the international space that they can use as well, where they don't have one today. And then the last one is that T. Rowe Price 2060. You guys just keep hiring younger and younger people, so this is just an older vintage that comes in for those that you're hiring now that are in that 20 to 25 age group that fund would fit them.
So are any of the funds in the first four, are they actually on watch?
No. The index fund, we don't apply the criteria of being in the top third because it's an index fund. So just a reminder there, the index funds they kind of fall outside of that criteria. But we do monitor them, we look at the expenses, obviously we track how close they're following the index.
So would you be recommending these same funds regardless of whether you ultimately do or don't have a collective investment fund?
Yes.
There is one of the fund recommendations that is on watch, so the bond fund, the Janice Henderson, and is
Oh.
on watch currently.
Yeah, I thought, was your question, are the ones that we're recommending on watch?
Yes,
Yeah.
Like the replacement ones,
Yeah,
right?
correct.
Yeah, no, the,
So
wait a
he's
minute, she's saying
asking,
yes and you're saying no.
he's asking if any of these ones that we're recommending a replacement are on
yeah,
watch.
I think your question is, so we're recommending Metropolitan West to replace Janderson. Is your question, is Metropolitan West on watch?
No, my question is, Janice Henderson on watch.
Oh, yes,
Okay,
yes, sorry.
no, that's okay. And are any, yeah, are any of
Lindsay
the,
understood it correctly, I did
are
not.
any of the other funds you are recommending to replace on watch? Or is that the only one?
If we go down to if you go down to page 30, this will actually give you the full report that shows you which ones are on watch. And that is Janice Henderson is the only one that's on watch.
But then if you go later, we compare the
Yeah.
funds versus each other.
So you've got a head-to-head comparison for each one of them on those that we've recommended.
Starting on page 38, moving forward.
So that was, I know from a couple meetings back, initially you had a number of funds, and I know Dave kind of said, hey, great if they're meeting that, but are these your best funds? And so that was kind of where we came with, hey,
Right.
these are the ones that we have highest conviction in, and then we kind of gave you a head-to-head comparison of each. I mean, the good news is you only got a couple of funds that are on watch, and you'll, and the one that we've got, the Janice Henderson, it's only been on watch since, I want to say, March or end of the year, so it's not like it's been on watch very long.
So I guess, my question is.
Yeah, March of this year.
I feel, well, it's not a question. I feel, comfortable with the one that's on watch, not as much with the other three, just because that's, the policy states that they should be on watch before we make a recommendation to change. However, I know that, Dave had asked about, better funds. Can you give us an idea of how much of our investments are in these, three funds in the large cap that we'd be
Yeah.
moving?
So your Investco Growth and Income has just under $1 million. The ClearBridge Large Cap has $2 million. And the JP Morgan US Equity has $1 million. So you've got roughly about $4 million
That is just in one plan.
in that large, yeah.
That's in the
excuse me. That's in the
457, so you
457.
have them
So
added
let-
together.
Yeah, let me go through, thanks Lindsay. So you've got, that's in the 457, in the 401A, you've got 1.53, you've got about 8 million, well, 7 million in the 401A, and then you've got 26 million in the 401K in that large cap space.
Okay. You know, the balanced, fund, makes sense to me, just because, like you said, we're having more employees that may need to go out that far. The international funds, is that something that is really going to be something that our, investors want to see? Is that those extra international funds, additional international funds?
Yeah, so currently in your lineup, the only international option they have is the American Funds Euro-Pacific. And the Euro-Pacific is Europe and the Pacific, so it's very little, it doesn't hardly have any emerging market exposure, which I think that's why the recommendation for the Fidelity Emerging Markets is for those participants that say, look, I don't want to just invest in international developed markets. I don't want to just invest maybe in Europe and Japan. I want to actually invest in China, India, some of those emerging economies. We feel is giving them an option to do that.
As
And-
well as, there's an index in the
Yeah.
international space as well. So if someone wants to be an index investor, they don't have an option in the international.
Anyone else have thoughts on those?
Just a question,
Mhm.
with these changes then, do we have your recommended best funds?
Yep.
So our options would track with your best recommended funds in the various categories.
So the recommendations that I just went through, are basically saying these are in each category, this is the manager where we have the highest conviction, regardless of whether or not your manager currently in the plan is on watch or not.
Right.
So Ralph, you bring up a good point. I think in terms of investment policy statement, again, it's not a contract where you're saying,
Right.
hey, they have to be on watch for us to change them, or once they're on watch, we have to change them. There's language in that policy statement that talks through evaluating each manager and determining which ones fit the best criteria. What we of course are doing there is saying, hey, look, any manager we put in the plan or look at, these are the criteria with which they have to be monitored. And so I think that's kind of a question for the committee. There's two questions here. One is you do have a couple of options. You kind of have three options that are, or a couple of options that are in the same space. So the argument is, do you really need two large cap value managers?
Right.
If we're going to add a couple of index funds, trying to make sure your fund lineup doesn't get so large that employees look at it and they just they get paralyzed with indecision because they're looking going, oh, I can't figure out what to do with 30 options. So we try and keep it between about 18 to 21 in that range. That's what we've kind of found is a pretty good balance. But you've got, the other good news there is you've had good managers. It's not like you haven't had, these aren't funds that have just done terrible or they're woefully inept at managing money. They've been good and they've performed pretty well.
Well, I would make a motion that we recommend to the Board of County Commissioners that we adopt all of the fund recommendations as set forth on page 5 there, which will bring us in line with all of the recommended funds of Soltis. I think part of the explanation for those changes is that we did bring Soltis in as our investment advisor, and now all of our funds will track what they view as the best options for our employees.
Kelly, do you have any issues with record keeping any of these?
Oh, Mark,
Again,
yeah. We've-
very,
We have all these
as-
with other plans at Prudential already, so,
the Grandeur
that's-
Peaks one too?
yeah.
We
The-
have it on our platform?
The global stalwarts you do.
I'm sorry, what?
The global stalwarts, yes.
So, but not this particular fund, the Grandeur Peaks?
Yeah, the Grandeur Peak Global Star, they have like 5 funds.
Okay, so if we
4 of
can't
them are
get
closed,
yours,
but
you'll
Global
go
Star
into a
Wars-
different one, a different share class, or?
Yeah.
See, because when I did the research for this last time in the last committee meeting, this particular one that he's showing is too small to go on our platform. So
Glo-
if there's a different fund that we already have on the platform,
I thought that was
Yeah.
a different fund.
but again,
Yeah.
I was told no from the investment platform
Okay.
people. I know you're working with Tina, so I don't wanna muck anything up.
Well, and let's circle, because we have plans at Prudential that already have global stalwarts. They have a couple of, I wonder if you're looking at they have a couple of smaller portfolios that aren't available because they're closed already. But this
Okay.
one's a larger one, and it's
Yeah,
we have it there.
but I have to go back to
So-
putting some of these smaller funds on the plan.
Yeah,
And our investment people that actually do the work and contract, if there's new contracts that have to be sent out, if there's new work that has to be to put it on the platform, it remains to be seen. So I can't tell you yes or no right now. I need to, if you're voting to try to add these, then I need to go back and let that team know that they voted to add them and get back an answer to you. Okay?
Well, I would amend my motion to, that recommendation go to the Board of County Commissioners with regard to all funds for which Prudential has an ability to record keep.
Right.
Yeah, and I'll get back to you as soon as I can.
yeah.
I'll second.
And just let me know, because like I
I
said,
will.
we have other plans that are
Okay, sure,
there.
sure. I'll keep you in the loop.
Yeah, I'll second that motion. I need to speak into the mic here.
Okay, we have a motion and a second. All those in favor say aye.
Aye.
Aye. Motion carries 4-0.
Okay. Get back to our agenda, we're moving through. I think we're there. The last thing, this is just an item of discussion, then we'll turn it over to Kelly to go through the Prudential report. Currently on your plan, you have, this is your QDIA, it's called the Goalmaker Portfolios, and it's through Prudential's platform, and what it is Prudential has in their platform, they have what are called the Goalmaker Portfolios that are set up as like a target date. They can be like a target date with a target date on there, or they can be a risk-based. But when you have employees that say, hey, I don't really know how to build my own portfolio, I want to have kind of get help or have somebody help build one for me, Goalmaker is available, and it's your default option where participants can go in, and what Goalmaker does is it takes the current investments in your menu, okay, so and they build an asset allocation portfolio for that individual based on that individual goes through a number of questions and risk questionnaire, et cetera. And then that Goalmaker portfolio will then also have a glide path. In other words, it'll say, hey, if you want to have this track with your age, it will work like a target date. So it's kind of like a custom target date that is built for your participants in the plan, and it moves right along with them. Okay, so similar to T. Rowe Price, but rather than having T. Rowe Price as kind of the underlying manager, it's taking the investments in your current menu and doing that. And Prudential drives the managers that are in that. They drive the asset allocation, all those type of things. For most of our plans that we manage, they actually have us manage those portfolios. And so we go in and help drive the allocation. We select the managers and how they do that. And we make some adjustments based on the markets and some of the things that we see. So you can do it either way. There's not additional cost. We don't charge extra to do that. Prudential can do it. They run it, and they run their optimizer, and they have it. Or you can have Soltis do it. Historically, we've had pretty good track record as we've taken those and managed those portfolios for our clients. But the discussion we want to have here is that something of interest to the committee of looking us work with Prudential and begin to take part in managing those, or are you comfortable and confident with the way that they are currently?
Do you want me to kind of elaborate
Yeah,
on that?
yeah.
So you're talking about Advisor Goalmaker,
Yeah,
correct?
yep.
So the difference between Goalmaker and Advisor Goalmaker is that we hire Morningstar to put together the asset allocations in the plan. So if you look in your book, and we don't need to do it right now, but towards the back, it'll have how much is allocated to each one of the funds that we have selected to be in Goalmaker. What Soltis can do, and what a lot of our advisory firms like to do, is to manage those at that amount. So, in our conservative sleeve of Goalmaker, you might have 16% going to the guaranteed income fund. Well, Soltis might say, I think it makes more sense to have 6% go to that and maybe some more to fixed income. They can manage inside of those sleeves. And either way, it doesn't, with Goalmaker, it doesn't really matter to us. We just need to know if you would like them more involved in the asset allocation tool inside the plan, so that they may be able to add index funds to the plans. They might be able to add certain other specialty categories like emerging markets is on there. We also have some real assets that we can put in through the Advisor Goalmaker. And so it really doesn't matter to Prudential which one you work with. It's just If you'd like to involve them to maybe give you a little bit more of a managed account than what Morningstar gives you, then it does seem like it's beneficial to a lot of, because you get more for your, more assets inside the category.
Are we paying a fee to Morningstar for
Nope.
that service?
Nope. Mm-mm.
Nope.
It's free, either one are free.
Well, I'd like more information
Okay,
to
I
see
mean,
if that's,
what,
makes
what,
sense.
Absolutely.
what we would do is we just come and maybe lay out, hey, if you wanted us involved, this is what it would look like, and we can take you through it for the committee. I think
And
before we went to
would you
that
lay out the new asset you
Yeah,
can show them what the,
yeah,
what might
I
look
mean,
like.
we can, yeah, we can go through all of it with you. And I think before we go there, and we wanted to make sure in terms of whether or not that's of interest to the committee and doing that. I think is, we've had, most of our plans where we've come on, they've liked us and wanted us to do that. And then historically, the track record, as we've come in and helped manage those, has been pretty good.
So how much of an increase in return have you been able to generate by doing that?
It depends on the plan,
And the quarter.
and the quarter.
I mean,
But-
just over time,
But
rolling average or something.
you know, I'd have
Percentage
to, I'd have to
point,
go back
or-
and look. Yeah, I mean, we've tracked it. For those clients where we've tracked it pretty good. And it's, you know, it really does depend on the client, which I wouldn't be able to give you probably a clear answer that I'm sure is accurate. I mean, we have one client coming up in a couple of weeks we're meeting with, where we did this with, and I can probably go back and share those with you once we have them. We're actually working with Prudential right now to kind of help us track that.
I mean, I'd like to hear that.
Yeah, yeah. So I think for us, there's a couple of things. Morningstar does a good job. There's that. I think, you know, we have the ability to be a little bit nimble. So in other words, in those portfolios, we can go in and we can look and say, hey, you know, we think there's some opportunity here. We make some adjustments over time, and we do that maybe once or twice a year. We're making small adjustments based on some of the market conditions and driving some value and like Kelly said, asset allocations and those things.
Okay.
So what we'll do as an action item for next meeting is to kind of take you through that. We can help show you kind of some results and track record and some of those things. Okay, Kelly,
Yes.
the time is yours.
So we will, let me get to my book here. We'll go ahead and start at the beginning. There was a couple of things that I provided in, extra as that was recommended by the committee the last time we met. If you start on page 4 of the executive book, we'll just go ahead and review the balances of the 3 plans. Total balances as of 9/30 was 163,283,551, with about 105 million of that in the 401k, 34 million of that in the 401a, and about 23 million in the 457. We have 216 participants with balances in both the 401k, or the 457 and the 401a. 326 that have it in both the 401k and the 401a, and that is the 2 plans that will merge together. So it's going to lower the total cost of 326 people for those 2 plans once we merge the 2 plans together. And then 213 participants that are also in all 3 plans, which will have some cost savings to those participants as well. If you want to move to page 8, the committee asked that we add in the expense account. It's our monthly expense account that Carol, our client service manager, manages for us. So what I did is I added it for all 3 plans. And you'll see 3 pages of it, and it's a rolling, I guess it's 1 year, 4-quarter, rolling, we're gonna have rolling 4 quarters though. So what we're gonna do is we're gonna drop off the old quarter and put the new one on. So it kind of shows you from a standpoint of what's happening quarter by quarter. And that will be included now going forward. Does anybody have any questions on that new ad? Okay.
Nope.
So if you turn to page 12, I'll quickly go over the dashboard because it's been a while since we've kind of taken a look at what the plan looked like overall. So this is this is looking at quarter by quarter or I'm sorry, year over year for the last 3 years. And this would be for the 401K plan currently. In 2000, end of 2016, we were about $84 million. And then in 9/30 of 2017, that moved up to a little over $95 million. And then as of June 30th, 2018, that number grew to $105,606,521. So I do want, and Tyler didn't get a chance to talk a lot about the economics and what's going on in the market, but I will tell you that it's been a turbulent 6 weeks from the close of the end of the quarter. So as of access yesterday, the 401K was at $100,109,557. So we're down about $5 million in market fluctuation. So just thought that would be interesting to note. But we've swung $5 million easily up in a quarter too. So I don't think we really need to worry about it. The next graph we have here is really looking at by generation, and obviously you can see where your dollars are sitting. The majority of the dollars are in those two generations, Generation X and Baby Boomer. So we do know that we have significant amounts of people who are ready, or within the next 7 to 10 years, really getting ready to retire. So again, as we talk about how do we reach those people, but between Soltis and ourselves, we'll put a nice communication plan together to make sure we're addressing some of those pre-retirement needs. Then we can go ahead and move to page 16, and we'll just quickly go over the quarterly demographics. Total participants at the end of the quarter were 1,261. Remember, this is just the 401K. Active participants was 973, and terminated participants were 282. We had 4 people with suspended balances. Now, as of February of next year, most of you are probably aware that there was a law passed in February this year that says that we no longer need to suspend people from putting contributions in if they want to take a hardship, and they also no longer need to take a loan first. So those are 2 things that I know that you guys are non-ERISA, but you have been following the ERISA guidelines and rules of these 2 things. So we'll need to talk about whether you want your participants to still take a loan before hardship. But we will, as of February, be able to record keep not suspending people from a hardship going forward. So they'll be able just to take a hardship without a loan, okay? But that's what those numbers are. And so Lindsay, we might want to add that to the next meeting to just talk about what they want, if they want to change their loan policy statement or their hardships. Because we really can't even record keep it till sometime in February because we have to change our whole system on how things are done. So we're targeting February. So the other thing is which we kind of talked about, was total assets for participants 50 and older is about 62 million. So it's a large chunk of those with assets in the 401K plan. Everything else just talks a little bit about your contributions in. We had almost $900,000 of employee contributions and $720,000 of employer contributions in the quarter. And then distributions out were about the same, about 1% of the plan was distributed. Just for the sake of timing, we'll talk very quickly about Goalmaker. This page, the next page on 17, talks about the plan assets for participants in Goalmaker has gone up to about almost $39 million. So as we talk about, there's quite a high percentage of people, 50% of your plan is in Goalmaker in the 401K plan. So it would have some effect working with Soltis for Advisor Goalmaker because there is high utilization in that plan. 641 people are participating in Goalmaker. Income Flex, that's something we haven't talked about a whole lot, but it does work in conjunction with Goalmaker. Really what that is when you get ready to retire, it's the guaranteed income stream, a feature that we have on the plan that allows you to take your 401K money and, for lack of a better term, it's not an annuity, but to annuitize it to pay over a lifetime. There's right now 17 participants. I know that when we put this in, when we came back to Prudential in 2012, they put it on, but since then, we haven't done a lot of education, and that might be something, going forward in 2019, that we can build into your communications and education, is to help some of these people getting ready to retire, to see if it makes sense for them to create an income stream from their 401k. Roth assets, you have 164 people participating at about 13% participation rate. We do automatic enroll people. We have 44, almost 45% of your population contributing in automatic enrollment status, which means we consider them a default investor because they haven't really gone out and made any selections of their own. We have a high utilization in our stable value. We did just do some pricing changes to the stable value, and you'll see the wrap fee that used to be on there of 20 basis points was negotiated off in the new pricing. So your net rate will go up by 20 basis points starting January 1st. So that's a nice increase for Utah County. And then I just look over to the transaction summary. I just thought it might be interesting to note the increases and decreases in contribution rates. We had 42 people increase, but 49 people decrease. So, that again might be something we want to target, is why it makes sense to save more and not certainly go below the 6.2 match, because you're leaving money on the table, and that is also the offset of Social Security. So that could be something we can work with to really try to drive the needle to make sure people understand the ability to save within the 401k, either tax deferred or Roth. I also thought it would be interesting, we'll spend some time on some other pages, is looking at the benchmark trends on page 18. You have automatic enrollment in your plan, and we have about 50% of our plans use automatic enrollment. The industry average is only 30%, so we're doing pretty well. You also have your plans match at default rate is 6.2. Most plans are 3%, so you can see that that's a nice match that you get as well. We don't use contribution escalation, but we do use Goalmaker. We have 19 investment options currently. In comparison to the average, our book of business tends to be lower, but the industry average seems to be a little bit higher. Plans that allow Roth would, you will allow Roth, and most plans, we've seen a real take-up rate in the Roth as well. People have kind of rethought about it now that the market has gotten a little bit better. Your participation rate, the next page on page 19, is at 79%. Our book of business rate is 70, and you're right about where the plan sponsor average is again about 79%. Your average account balance is a little bit higher than our book of business, but certainly right at where we're seeing the plan sponsors' account balances. And I would say that, to note too, that you have a very nice retirement pension plan. So, that's a pretty healthy amount, even because not everybody that's going to be in this is going to have a pension plan. We've got about 19% of our stable value assets against Prudential's book of business is at about 25, so that's good asset allocation and diversification there. What else is here? And then the only other thing might be our loans. Our loans might be a little high in comparison to the others and plan sponsor. However, and I didn't think we would have time to discuss it today, but I know we mentioned it in our sales final, is our new emergency savings solution that we have, that we can use an after-tax source to allow people to save additional dollars after tax and use it more frequently than a loan. And if that's something that you think you might have interest of, to maybe start driving down some of that loan utilization, we can put it on a future agenda. Let's see. Oh, my computer froze up. Is there an extra book around here? No? My computer just froze. Oh, there it went. Never mind. Got it. It moved. Okay. Let's see. The rest of these I've, as again, interest for time, I've kind of went through most of this. The only other thing I would maybe talk about a little bit is, and I know this has come up in the past, is the participants that are solely invested in one fund. Currently, we have 83 people solely invested in the Guaranteed Income Fund. We've got, the retirement funds really don't matter. Then one-offs, one here and one there, and sometimes it is important to make sure we're looking at and paying attention to those people. So our participant engagement, sometimes when you get those happy birthday or the plan anniversaries from Prudential, we also now are starting to target people that are having some asset allocation challenges, just reminding them why it makes sense to diversify and to maybe asset allocate. So that isn't something that we necessarily have to do from a custom perspective, because we'll be adding it by age group to age appropriate. So let's say that these 83 people in the guaranteed income are all within 5 years of retirement. We wouldn't send it to them because we know they've probably made a conscious choice to be in something that's guaranteed. However, if we've got 50 of the 83 that are 27 years old and maybe they don't understand that, you know, what they might be missing. So we will at Prudential target those without having to go through a custom communication campaign here at Prudential. Is there anything else that, that I missed here? All the other benchmarks and demographics for the other two plans are going to be very similar, but they're much smaller and they're limited to who participates in those, so I don't usually spend a lot of time on those. But is there some other questions I can answer for you?
Is your website, your new program up and running?
So, 19th. So I just sent it, Mark and Ralph just got an email today, you probably haven't seen it. Carol sent it out to you and Mark saying to, if you want, there's a little video clip that you could send out to your employees to kind of look at it and say, hey, this is what's coming on the 19th.
19.
So,
Do you guys need to motion to move the 401A to the 401K?
Yeah, I was waiting for her to talk about it. but-
Okay.
okay.
So
So I
yes.
briefly talked about it. So we have in, I would say, subcommittee, talked about what's the difference between terminating and merging the 401A where we have small participation and it isn't really open to anybody but elected officials going forward, correct? So what we are able to do is we're able to take that smaller plan and merge it into the 401K. Nothing would change for the participants except those dollars would be sitting inside of the 401K under a separate source. So all monies that come into a defined contribution plan is labeled with a source of money. So if it's match dollars, if it's your dollars, if it's IRA, rollover money, if it's 401A, profit sharing, all of those in a record keeping system, we go ahead and we just label those and we keep them in different buckets of money, right? So pretty much all that's going to change for the participant is they'll no longer get a separate statement for the 401A. There'll be another line item saying that you have this much dollars in your 401K bucket and this much in your 401K. And then if you're in all three, this much in your 457. So it's more of an administrative thing that will happen. We will work with Ralph and Mark, probably mostly during our bi-weekly meetings that we do have an administrative bi-weekly meeting where we'll just set up to have calls to make sure the document persons, we're going to compare the two documents, completely, make sure that we add it to your new document. And the only cost to the plan will be the amendment. There's an amendment charge of $750. It's considered a settler expense. So that expense cannot be paid out of the expense account. It needs to be paid by the county. So that's why we probably need to have a motion to.
Okay.
So how long a period of time to do
Sorry?
that? How long will it take to get it?
It doesn't, we can't do any document work from now to the end of the year because of course all the 1/1s changes are coming, but right after 1/1, we can have it done in 60 days, minimal 90 days. So by the April meeting, it should be done and we can deliver.
So,
Motion?
yeah, I need a motion to approve the merging of the 401A into the 401K.
So I would make a motion that we recommend to the Board of County Commissioners that we merge the 401A into the 401K.
Okay, do I have a second?
Second?
We have a motion and a second. All in favor, say aye.
Aye.
Aye. That motion will pass 4-0. Thanks.
And then the other thing that I included, I know that we have talked about participant communications and education, and things will be changing a little bit from the transfer of the different advisors and the new way of delivering. I know we need to have more discussion on the Prudential Pathways on-site meetings, and we're not really there. But the one thing that I did want to let you know is we have a monthly webinar series that I included in your book, and I just have to get back to where that page is in the back. Let's see. It'll be easier for me just to look in here.
96
Yeah, the very last
to
page.
97.
So this webinar schedule, what we have offered to our clients is you can go through those and look at any one that you think might be beneficial. But I've also had a couple of clients say, can we just sign up for all of them? And then we would send emails to your participants about each different topic. And so it's webinar based, it's not, it's, you know, it's all purely educational, but it has a lot of things on here that we wouldn't normally talk in an education meeting. You know, like budgeting and debt management, student loans, how do you pay off your debt, you know, your estate planning, that sort of thing. And this is really open to any participant to just log on. They'll be timed. It's always at 1 to 2 Eastern. So I just wanted to know whether or not you thought that would be beneficial as we went through the process of looking at education and communication going forward with Prudential. I wanted to make sure that lets you know that that's available. And alls I would need is an email from Ralph saying, turn us on for the whole thing for 2019.
Yeah, if you could send me an email to remind me to send you an email,
Okay.
I would say that's a go.
Are these available other times than the webinar
Yeah.
scheduled time?
Yes.
You can click in and,
Mhm. And we can
Watch
do
it.
1 hour ones, yep. So if we want to schedule some other ones through the pathways. Generally what they like to do though is, and I can see if we can get an exception, but the rule has been you do the on-site first and then you continue up with these follow-up ones. But I know we're not there yet because I want to talk to Soltis on how we can incorporate it for the best use of Utah County. But yes, they are available on one-offs as well. Because this is something everybody in the country can dial into. If there's something that might be more specific to Utah County, we can do a webinar that's going to be more specific to just your plan.
so did you need something with regard to sending the disclosure notices?
Well, you just have to tell me whether or not you guys want to send them again this year. Historically, you have sent the disclosure notices. You're not required to.
Well,
But again, Ralph, I just need an email. Do you want me to send you one
Yes,
saying?
please.
All right,
That would be
it'll
great.
actually come from Carol,
Yeah.
okay?
No, I don't see any reason unless anybody else on the committee to not send those out. I think
I
we
just
should
wanna
send
make
them
sure.
out.
Okay. Is there any other questions that you might have, or?
I don't have any. Anybody else?
Well, I want to take this opportunity just to thank you very much for looking at Prudential and giving us your vote of confidence to continue with you. I think I told you guys in another meeting that I don't lose clients very well, so I'm very happy to work with you on an ongoing basis, and we have given you another 5-year guarantee, rate guarantee, so here's to the next 5 years, and thank you again.
Yeah, we are looking forward to working with you over the
Good.
next 5 years. I
Good.
think it'll be great.
Thank you.
Okay, thank you, Kelly. We'll finish here with our last agenda item, just, which is an education and participant, support report that I'll have Lindsay kind of go through as she spearheads that with our team, and I'll turn it over to you, Lindsay.
Okay, perfect. We'll go to page 110 in the packet. So this is the education and communication calendar. The results are on the right-hand side of 2018. We have scheduled our 2 other on-site days for the remainder of this year on November 28th and December 17th. Ralph, I've sent it out to the participants that signed up during the benefits fair, and then they'll be also sent out soon by Ralph. Get those scheduled. Moving forward in 2019, we will be coming on Tuesdays so that we can cover the enrollment meetings for the new employees on Tuesdays, the second Tuesday of every month, so that we can hit two birds with one stone, right?
Will be good.
Also, I've been working with Carol on getting a list of those participants that are in that stable value as their only option, investment option. And so we've been working, we'll target those employees as well. So we'll send them an email just to have a discussion. Like Kelly mentioned, if they're close to retirement, it may not be a discussion, but I met with a participant the last time I was here, and they didn't realize that their entire account balance was in stable value, and they were not within 5 years of retirement. So we were able to make that allocation change. We do have our retirement readiness tomorrow in Salt Lake. And so there are a few county employees that are scheduled to come up there. We host those semi-annually, and so the next one will be in March or April of 2019.
Did that notice go out to our employees?
I believe so.
Yeah, 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 it should have.
Okay, I'd send it around.
My main annual is gonna be retained, so.
Yeah, and then let's see. So for 2019, we'll just target those stable values. Then we'll continue doing our education. It seems as though, the response to our presence has been very positive, and that we have quite a few people that we've built financial plans and helping them to get everything on track. A typical meeting for those of you that aren't aware, we have 45 minutes scheduled, and we go through a holistic view of their retirement landscape. We can also make investment recommendations and also talk them through whether traditional or Roth contributions would be more advantageous for their situation. So kind of giving you a viewpoint on how those meetings are going, but been awesome. This year we've had 2 advisors at each of those days of education, and jam-packed the whole day. That's all for my recap.
Okay, great, thank you.
I think that finishes up. We've got notes and follow-up, of course, that will come, that we'll send to the committee for review, and then we'll come back on those. I think just around the education, real quick, I know we're slated to try and ensure that we're here basically on a monthly basis. As Lindsay's indicated, we've had good demand, which is good. And when we sit down with those employees, it's really, we try and make that meeting as much about them. So if they want to pull up their account and look at it, we go through that with them. If they need more of the conversation around planning and holistic, we can do that. As part of that process, we'll build a plan. We actually will, as part of that plan, they'll have their own personal financial website that we build for them that they'll have access to. And they'll be able to access that and use it as long as, Soltis and Utah County continue to work together. And so they've got multiple resources to do. And then we try to be very consistent in terms of Lindsay, and Jeff Levitt is our other advisor that's been here. We try very hard to make sure that we have the same advisors so people know them and they're here. We can't always guarantee it will always be the same person, but we try hard to do that so that your employees know who they're talking to and doing that. And we appreciate the chance to do that. And I think, as Lindsay mentioned, there's good demand, and we see that more and more among all of our plans. We know that people need help. They want to have conversations and talk, and so we're geared to do that. So,
Great.
any other items that still need to be discussed, or?
Is your webinar retirement readiness, is that available to log into and watch as a webinar?
For tomorrow night, yes.
It is?
Mm-hmm.
And
I think just as a reminder,
Eventbrite? No? How will you log in? Just on Soltis?
once you register, it'll give you the instructions.
Yeah,
Basically,
so-
it'll just give you a link you can click on and go into.
The webinar instructions are on page 118.
Or on the invite.
Sounds like I need to send that out again.
Did you get it? Did you get it? Any webinar for the retirement readiness?
I know that I have county employees signed up, so
Yeah, I think I
And-
sent it out to everyone but you, Dave.
I'll group message
I have to
Sans
see.
Dave.
Once it's out of my
Oh, here it is
inbox,
right here.
out of sight, out of
Yeah, I know.
smell.
All right, I think that's it for today. anything else from the committee?
Well, if we could have on our next agenda to adopt a, electronic meeting policy.
Hmm.
So that if we have a need, just have someone participate
Yeah, there.
electronically to get a quorum, we'll have the ability to do that.
I like it. Okay, can I get a motion to adjourn?
Motion to adjourn.
Second?
Second.
Motion and a second, all in favor say aye.
Aye.
4-0. Aye.
Okay, thank
Yeah,
you.
get staying.